Gillian, I want to start with you because you, in my experience, were one of the early ones talking about inflation. And people are coming around to your view that at least we should be talking about it, even if it's not here. And let me start with the most basic question, I think, which is, what's the difference between reflation and inflation? We had Chair Jay Powell this week say, no, this is just healthy because we're just getting back to normal in the economy. When do we get worried about it?
Well, the point is, David, that actually the difference between reflation and inflation really is in the eye of the beholder. It's when prices go up. And I am not arguing that prices going up is a bad thing. Absolutely not. It's exactly what you expect to see when you have a recovery. What is a bad thing, though, is to have a market completely positioned around the presumption that either prices will never go up or that the Federal Reserve will never raise rates. And that is essentially where we've been in the last few years. Now, you're starting to see some investors say, well, actually, we should start preparing for a regime shift. But to my mind, the question is the Fed doing enough to make investors understand that there's a two-way risk right now around prices and rates, or is it still lulling people into this false sense of security that rates will stay low forever? And my concern is that it is.
Well, Peter, certainly nothing in Jay Powell's testimony in Congress this week would really avoid that lulling into a sense that there's not two-way risk. But are the equity markets pricing this in at all at this point?
I think the equity markets are beginning to take notice of the principles that Gillian laid out. I actually think she laid it out perfectly. We need a healthy environment, which means that prices go up. It doesn't mean they go up at 4 or 5% a year, but it does mean they go up at 2 or 3% a year. That's a healthy environment. We haven't actually been in that kind of a price regime for quite some time. And real interest rates, which are key to the actual economic consequences of the marketplace, have been negative. They're negative in Europe and they're negative in the United States. And the Fed and the central banks around the world have, as Gillian points out, for the last 3, 4, even 5 years, been very aggressive at injecting liquidity into the system, forestalling any potential decrease, and creating lots of interest in negative real rates. And so the market has become accustomed to that as a reality. And when the market becomes accustomed to that as a reality, it starts to overpay for securities that do well in that environment, and it underpays for securities that do poorly in that environment. And if that's persistent, you get a wide gap in valuation. And that is where we are coming into this actually last 2 or 3 months where rates have gone 40, 50, even 60 basis points higher. And the volatility we see in the market right now is the market trying to reconcile the points that Gillian made.
So, Peter, there was a time when we talked about basically 60-40 blend in your investment decisions. At this point, does it make any sense to be in fixed income at all?
Really good question. Fixed income is as expensive as it has been in probably 30 years. You know, I'm a little bit of a historian or economic historian. I like looking at the history. 1982, 1983, inflation, which was real inflation, was 7, 8, 9%. And the 10-year bonds were at 13, 14%. And since then, we've done nothing but see a reduction in bond yields and increases in prices for 37 years. So to think that you're going to stay at this level of yield for the next 5 years is just irrational. Doesn't make sense. So if that's the case and you're an investor, not a trader, but you're an investor over the next 3 or 4 years, you have to be thinking that yields are going to rise. You have to be thinking that duration is expensive. And so if duration is expensive, why would you hold as much of it as you normally would? The other side of that, of course, is equities will outperform bonds. By the way, in that 30-year time period, equities underperformed 10-year bonds, which is highly unusual. That's not going to be the case going forward. Now, I'm not telling you that equities are going to earn 15%, but I am saying that equities are going to outperform bonds. So one could argue that 60-40 is probably a little conservative, and that maybe 70-30 would make more sense.
So, Gillian, it sounds like equities might be the place to look, at least initially, but it depends on which equities. Another thing we saw this week was really what looked to be perhaps a rotation away from tech, which have been doing so terribly well, and into some other places like energy and financials, presumably because of the prospect of our returning back into the marketplace. Is that a rotation that will continue, and how big could it get?
Well, I think the rotation is going to be significant for some time. I'm not like Peter, paid to give us, investment advice or precise portfolio allocation ideas. However, I think one of the things that's going on at the moment, apart from this recognition that at some point the economy will reopen and there is a chance of, quite a sharp rebound, at least initially, is also recognition that some of the tech stocks might have got way overhyped. Because yes, we are seeing a really quite remarkable tectonic shift in terms of our reliance on digital platforms. But we're also seeing a world where there could be regulatory clampdowns and where much of the exuberance around tech stocks has probably got pretty bubbly.
So, Peter, over the medium term, not the immediate, as you said, we're not traders, we're investors, but over the medium term, where do you think that there might be bargains left in equities?
So I think that I would give you a little bit of a nuanced commentary on technology. So there are definitely, to Gillian's point, there are definitely technology stocks that are overvalued because in the work from home, high amounts of liquidity, negative interest rates, investors have valued long-term growth with very low discount rates and bid up the multiples. But there are also tech stocks that are actually quite innovative and whose earnings are actually going to grow because their market shares are going to grow dramatically. And those tech stocks, even in a period of time when tech is actually going to underperform, will do well. So finding the innovative tech stocks, and there's plenty of innovation going on, because one of the things that COVID has created and the pandemic has created is real changes in the way that businesses prosecute their model, their business model. And those changes are creating dramatic changes in market share. So one thing to be careful about is just don't throw the baby out with the bathwater. There are innovative tech stocks that are going to be very attractive to own. To your point, David, that what is the undervalued area of the market? Well, the clear undervalued area of the market are the quality stocks, which haven't participated in the reflation/recovery. There are plenty of strong quality stocks that have strong growth that now people will start to look at as the economy starts to come back and the global economy recovers. That's a place where there's actually undervalue. You wouldn't think it. You'd think, well, let's look at the bombed out stocks. Actually, the bombed out stocks have done pretty well over the last 3 or 4 months. But the quality stocks nobody sort of looked at because, at the end of the day, well, they're just sort of normal quality stocks. But those quality stocks have big market shares, strong brands, and as the economy recovers, they're going to do pretty well.